Welcome back to another episode of Schaeffer's Market Mashup. I am thrilled to bring you another collaboration with Cboe Global Markets, featuring not one, but two recurring guests. Please welcome back Rob Hocking, the head of derivative strategy at Cboe. The last time we talked, you were part of our popular top 5 mistakes options traders make episode. So how have you been since then?
Yeah, wonderful. Thanks for the invite back. Excited to be here and go through a little more of the product design and introduction of product stuff that we're doing here at Cboe this go around.
Great. And joining him is Michael Izhaky, VP of Derivative Strategy. Good to have you back, Michael. You were last heard from when we did mini VIX futures, if I recall.
That's right. Yeah, thanks for having us in here to talk about this exciting new product, and it's definitely great to be here again.
Cool. And how I would be, not a good host if I say, how is Chicago? I see you guys are together.
Yeah, nice today. Temperature dropped a little bit, but you can tell fall is in the air, but nice and sunny.
Good. Yeah, same here. So, nice Midwest day for both of us. So we're here to talk about some exciting new developments over at Cboe and the impact it will have on retail options traders. And I'll let you guys take it away from the jump, but what is this Nanos I keep hearing about? Give me the 5 W's, who, what, where, when, and why.
Excited to be here to talk today about this. Everyone has seen the retail explosion over the past 18 months. Options trading by retail investors is up roughly, call it 4 times over the past 5 years. And with this, I always love the stat or quote that came out of the OCC recently that said almost 39 million options contracts have traded each day in 2021. And that's up 31% from 2020 and the highest level since market inception in 1973. And so as this retail segment grows, we see it as a unique opportunity for Cboe to expand access to options and create a product that allows what we're calling Main Street the benefits of Wall Street. And that is a price point friendly contract, and that makes options trading much, much simpler.
Yeah, just to add on to that, we've actually spent the past 9 months getting to know, what we view as a new potential user and segment for options trading. And through market research with an outside consultant, we conducted surveys, focus groups, and really kind of discovered that there's this newer, larger retail segment out there that are interested in using options if they were more accessible, simpler to understand, lower price point that we'll get into in a little while, and some of the other features and characteristics of the contract that we think makes it appealing to this new segment. 75% of those that we surveyed that were familiar with options said they would use them if they could be done at a lower price point. So we're excited to bring this product to bear on this market segment, and we think that there's going to be a lot of demand for Nanos as people learn more about them.
Mm-hmm.
And just for your listeners, to make sure it's clear, we're excited to grow the pie. We view this as the introduction of a complete new market segment. So if you're trading options today and maybe you're a SPY options trader, maybe you're an XSP options trader, that's great. The idea, and as we go into the product specs of this very small contract, is to trade the biggest contract you can. But a lot of our research that we've seen have showed that maybe in these smaller accounts, people just can't access options at all. And so that's the idea of coming in with this newer, smaller contract.
Mm-hmm. I like it. Rob, you came out with some stats, and I've got one to throw back at you. Friday's volume was a little north of 57 million contracts, according to the OCC. That was the second largest in the history of options trading. And the first was January 27th, a little north of 60 million. So what I find interesting there is the January 27th was at the peak of the meme stocks, the apes, whatever you want to call them. But it's clearly been sustainable if after, 10 months, we're still seeing this volume. This was not a flash in the pan. And it's clear that you guys recognize this. We over at Schaeffer's recognize this. And you're doing something about it. And then, Michael, what you were talking about with the concept of options trading is quite overwhelming at first. There's a lot to unpack there. So start with some of the essentials that traders should know and some facts that are kind of commonly overlooked.
Well, yeah, actually, Patrick, you don't mind, I'll kick that one off, but I wanted to comment on what the stat you just threw out there. We both, and Cboe as a whole, really views this new investor class that's coming into the market. They're here to stay, and we're really excited about that. I think another CNBC stat that I saw the other day on TV was in January alone, I believe, of this year, I think it was it 6 million people downloaded a trading app in that month alone. And you think about this, and once you empower somebody to take over, call it, their financial investing, I think you really create an investor, a long-term investor, and an investor for life. And that's what we're after with introducing this contract. So along those lines, with regards to the Nanos contract, between the top 4 retail brokerage firms, there are now over 150 million retail brokerage accounts. And so if you include the more than dozen smaller firms to that number, the number of accounts would be well over 200 million. And as we discussed, many of these accounts are too small to be able to take advantage of broad-based index options in particular. And I think it was Robinhood who reported out of their 13 plus million accounts, the average account size was under, I think, $2,000. So if you think of an index like the S&P or even the SPY level of a $450, call it index, that becomes a challenge to be able to access options at that price point. So to appeal to this new investor, the first of its kind Nanos contract that we're introducing will represent a simple, easy, and most important, affordable way to trade these options. And so simple because we plan to list fewer strikes to ensure investors are not overwhelmed with too many choices. In the SPX today, there's over 5,000 listed strikes. For Nanos, we're going to be talking about closer to 20. So very, very small number of strikes to make choosing simpler. Easy in that these options will have short-dated expiration cycles. So results are known quickly. Investors are able to reposition often. And again, we're looking at listing terms with 7 days or less to expiration. So think Monday, Wednesday, Friday, and the following Monday, keeping it simple. And last, affordability. With each at-the-money options contract costing around, call it $3 in this volatility environment, it allows those that have otherwise maybe been intimidated by options, a way to trade, a way to learn, without having to commit large sums of money. So Nanos will be 1/100th the size of our mini options contract, which itself is 1/10 the value of the SPX contract. So I know that can be a little confusing. Most simply, if an SPX options price is $1,000, the corresponding Nano price will be $1, something that's very accessible.
Yeah, and that's why we call them Nanos, right? Like when we were first looking at this, micros didn't quite cut it, right? Because micro would have been around $100, right? So for a mini product, mini either SPY or SPX with the 1/10 size, that would still have been $100. Whereas again, this Nano contract is $1, right? So one thing that's also worth pointing out there is that there are options that you can trade at a lower price point, but they tend to be very short dated and very far out of the money, right? So with being super far out of the money, you end up with lower probabilities of outcomes that you're looking for, right? So the key here is lower price point combined with options that are closer to the money and that are within, much more standard deviation wise likely to be at or close to intrinsic value at expiration. I'm not going to go into the weeds further on that. Happy to follow up on that front. But, if we talk through a little bit of, that multiplier having another effect is that if you look at an option screen right now and the price is $1 bid, 110 offered, right? You go to buy it for $1.10. Well, actually, it would be $110 that would have to come out of your account, right? So it's, for people like Rob and I who have been in the industry for a long time, it's just, we're used to it. It's a convention that we're so used to. But for people that are first coming in, it's a little bit, doesn't make a lot of sense, right? So the idea of it just being what you see on the screen is what you get. Of course, net of trading fees and costs. But that simplicity was another thing that we thought reduces a barrier. So, if you look at the index size being reduced from, let's say, 4,500 down to 450, and then also having no multiplier, or at least the multiplier being 1, that price access point for at-the-money contracts is much more accessible. Reducing the expiration dates and reducing the number of strikes also kind of gets that whole overwhelming nature of pulling up an option screen out of the picture.
Right. I've got a funny story. I remember when I was explaining the basics of an options contract to my dad, who's a lawyer, and he just kept going back to, but why is it multiplied by 100? But why? I think that's a sentiment that is echoed by a lot of retail traders starting out. And so to simply cut through that and have the one multiplier concept, it really does increase access, simplicity. I mean, it streamlines workflow. It seems almost too simple, like too good to be true, really.
Well, Patrick, also, the 100 shares is from a round lot, right? So the round lots used to be 100, and so it made a lot of sense if you were trading in round lots. And then also, Rob and I were talking about this. If you're on the floor, like when we first started out, you want to be 100 up or 200 up. You don't want to be like 20,000 up, right? So the multiplier did help people who were on the floors to communicate quickly as a convention, combine that with the round lots, and that's where you kind of get into it. Now people are not only trading single shares, but they're even trading fractional shares. So this was like a move in the right direction that we think that just simplifying it to reduce the barrier to entry makes a lot of sense.
It also helps just to highlight the cash settlement nature of our product. So because, to Michael's point, you're not settling into physical shares of stock, and the reason with that 100 multiplier of settling into one round lot, these settle into cash, which makes it very simple even yet again, because you don't have all of a sudden options turning into shares and then having to liquidate shares to close out of your trade. Your options settle into cash, into your account, and you're able to reposition shortly thereafter. And so the cash settlement nature of our proprietary product base and index options in particular was a big benefit to building out this Nanos contract and starting with the S&P first.
Right. Very well said. I want to explore a few hypotheticals here and some scenarios. Say I think the market is going to keep chopping lower in the next week. How would I utilize Nanos?
Yeah, so that's a great point. If you think about the opportunities now to kind of get short the market as a hedge, they're not very appealing, right? Nobody really wants to go sell SPY short if they even had the permission in their account, or try to sell naked options, right? So you can actually get short the market by buying a deep in the money nano put, right? So if we were to use an example of SPY, I'm going to use 450 as the example because I know it's trading at 467 right now. But just to keep the math a little bit simpler, spot's trading at 450. You could buy like the 460 put, which will be something like that will be listed. I think that just in terms of the strikes that we're going to be listing, there will be strikes that are really close to the money, and then a couple of strikes that are near the money, and then one or two that are pretty far out of the money. So in this example here, you're going to be at the 460 put. That would be approximately $10 in terms of how much that would cost you. So you could buy it for $10, and then if the market was to go down, let's say, so you go from 450, 1% would be $4.50. I'm just going to say it goes down by $5, right? The market goes down by $5, which is a normal move, like a 1% move or so is totally, happens all the time. So in that case, your $10 investment in that put would have actually made $5 of return, right? Now, a couple of points on that front is if you're just wrong and the market rips higher, the most you can lose is the $10 that you paid for the put, right? So if the market, in that case, was to go up 3%, then you would have basically done better than if you were short the underlier, right? This is probably a little easier on the long side. If you're on the long side and you have a deep in the money call and the market tanks lower, right, you could only lose the $10 that you paid for the option and not more than that. Whereas if you're long the underlier or short the underlier and it moves by more than your option price, you would lose more than that amount, right? So another really nice feature of this strategy here is you buy this deep in the money put, it's $10. If nothing happens, the option actually expires worth $10. So that money goes back into your account. And the next day you're up and trading, and you can either trade another one or you can use the capital for something else, right? With a physically settled share, it's still $10 in the money, but you actually have to deliver the stock. And then you have to go through settlement and wait for the funds to go back into your account to be available. Similarly, then, you're also exposed to the market risk when those shares hit your account versus when you're able to settle out of them. The net result of that is a lot of times brokers will force people to liquidate positions in expiring options that are physically settled so that they can not have to deal with this, right? Whereas with the cash settled nanos, they expire into cash, and nobody has to liquidate you, and you personally don't have to watch the flows to make sure that you trade out of them before expiration.
Okay, Rob, you got anything to build on there?
I guess one thing I'd say is, and obviously there's many use cases for this product and for options just in general. What becomes really important is, and in the big picture, is by introducing Nanos to this new investor, we're also very focused on education and making sure that there are resources available that can help teach users the benefits like Michael just outlined. And so in line with that, we're very excited to introduce on-demand courses, videos, articles in the upcoming months through our Options Institute, so our education arm at Cboe. We're also excited about exploring concepts like hosting office hours, where market participants can interact with a live instructor for direct educational questions. We realize sometimes this can be overwhelming, and sometimes people like that high-touch nature of a live instructor. So we're exploring that idea as well, because we really believe that this new market of users of options are here to stay, and we really want to try to build a robust resource profile around them so that they're here for the long haul.
Mm-hmm. Very well said. I'll get into the educational component here in a second. I did have two questions for listeners who are just completely maybe a little, get their wires crossed. This is an index product, correct? These aren't equity options?
Correct.
That's right.
Okay. And I think it would be helpful if you just gave like a quick 2-second overview of like in the money and out of the money. So when they're looking at these directional moves, a retail trader knows really what when they see that, they can kind of clue in on what it means.
Yeah, for sure. So a call would be in the money if the underlying price goes above the strike price, right? So you have the 450 call and the underlier goes to 460, then it would be 460 minus the 450 would be 10.
Michael, maybe it would be good to say, so a call gives you the right to buy the underlying, correct? So if you have the right, in Michael's answer or example, if you have the right to buy the underlying at 450 and the stock is actually trading 460, then there's $10 of intrinsic value there. That $10 represents in the money. You can buy it for 450, immediately sell it for 460. Out of the money would be the reverse. So like say you have a 460 stock price, but you're buying the 470 call. So the idea that you're going to buy the stock for 470, but it's actually trading in the market cheaper for 460 means that gap there is extrinsic or out of the money from where the stock price is trading.
Yeah, and so Rob's example there is like on a physically settled. So you exercise the option and you either sell or buy back the security. In the index world, what ends up happening is that they settle into cash, right? So your 450 call gets you the right to buy at 450. If spot's at 460, then it basically says, okay, so rather than you having to go to the market and sell it at 460, we're going to settle this thing at 460 versus your strike price. So that's where this whole benefit comes in, because the $10 immediately basically gets converted into cash, goes back into your account. in a physically settled example, you actually are long stock from 450, which, of course, is trading at 460, but by the time you get control of it, it could go back down, right? So there's an operational risk there as well.
Yeah, that's a very good explanation. I'm glad we paused for a second to kind of unpack that a little bit. And it was alluded to before, but I would be remiss if I didn't mention both of your own distinguished trading careers. For retail traders starting out, what are some lessons learned, perhaps the hard way? And then how would you give, what would be some advice you would give to your younger self when you're basically learning this whole new language of options trading?
So I came into the industry straight out of undergrad about 20 years ago, and I had very little understanding of derivatives and even more specifically the options industry. But it was exciting. It was very competitive, and I fell in love with that right out of the start. If I was talking to my former younger self, I would encourage him to do a couple of things. One, take advantage of the many resources today to submerge yourself in the learning. The internet wasn't as prevalent back when I first got in the business, and there were really, a couple of resources that you could use. One of which that my firm that hired me gave me right away was the Shelley Natenberg book. It was Options, Volatility, and Pricing. It was kind of regarded as the Bible for all young people getting into the market at the time. But now with the internet, you have, call it option simulators, online courses, etc., all at your disposal. Take advantage of them and really learn the ins and outs and risk rewards of the different option positions, payouts, probabilities, like all of that will get you more comfortable with introducing options to your portfolio. Second, I would say is a big one, and this one I tell everyone that asks this question, is set goals around your trades before you enter them. So strict entry points, exit points, remove emotion from trading, and it allows you to focus on building consistent strategies without that, getting sucked into that. I want to hold on to my losers a little too long, or I cut my winners because I'm happy a little too quickly. This concept is super important, just because emotion can really drive you in the heat of the moment. And the more you can remove that, generally the more successful you can be.
Very well said. And I love the continuity there because for faithful listeners, that was Rob's number one common mistake that options traders make back from June. So he nailed it right there. But Michael, what do you got for me?
I learned the hard way, Patrick.
There you go. Hey, that's how we all learn. Experience is the best teacher.
So I get to age myself further and say the internet was definitely not a thing when I got into the business. I started out with a firm called O'Connor and Associates back in 1994, and I think that the one difference is that at the time you would come out of university and go down to work for O'Connor or Hull or Cooper Neff and Susquehanna, etc., and they would send you down to the floor and they would also train you and teach you, and that was really the only way I would say to become really deeply immersed into options. Whereas today, I feel like you can really learn a lot about options. First of all, I'd say the Natenberg book for sure is a good one. Also, Macmillan had a book that a lot of folks have on their bookshelf that the things still apply to today. But in addition to the books, there's the resources that are available today. But learning the basics is really, really key, right? I wouldn't advise people to go in there and say, oh, well, people bought Tesla calls and it ripped higher and they made a fortune, so now I have to do that. And I think it's really important to understand the payoff profiles of a call, the payoff profiles of a put, and long call and short put and how they work together, because that's actually, even to this day, I still think back to two-week class from all the way back then whenever I think of any kind of an investment in a structure that includes options, because those are the fundamentals of all structured notes and everything else is just that type of a payoff profile. Other advice that I would give to people is trade more, and then that's trade simulators are also a great opportunity. One thing that I definitely didn't do enough of is that I would just be so gassed by the end of the trading day that I would just be tapped out, right? or just being in the markets, I felt like I wasn't really trading as much as I would like to have. And a lot of times just the repetition is super important. And the most important thing about working for like a Hull or an O'Connor or Susquehanna is the mentorship that comes with it, right? So what I would say to people is try to find a mentor, and that mentor could be an influencer who you trust. It could be the Options Institute, where you actually can get familiar with our educators and get to know them, and find folks that you really trust and believe in, and try to establish a relationship and learn from them.
Very well said. I like how both of you guys delved into the evolving mindset. I think you need to have the constantly evolving mindset for a trader, especially when it pertains to options. Because the more I become acquainted with this industry, the more I realize so much of it is about your kind of psychological well-being and how you are approaching things on a day-to-day basis. And I find that so fascinating, how you have to adjust to macro events, to your own personal experiences. And I think you guys both touched on that, very eloquently. So to wrap up, Michael and Rob, where would I go to find more information on Nanos?
So right now, Cboe's website has a bunch. What is it? Nanos?
Well, the email is nanos@cboe.com.
Correct.
And also, we certainly encourage your listeners to reach out to their brokers and to the people with whom they do business. And if they're interested in trading these products, to encourage them to add access. And our website for sure.
Yeah, the website right now, through links on our website, you can sign up for updates, because we're going to be sending regular updates as we get closer to launch here in Q1 of 2022. And as well as updates from our education front. If you guys want to get more education, all of that can be found on our website.
Wonderful. And of course, I'd want to plug Schaeffer's own Getting Started with Options program. It's chock full of everything you need to know about strategies, concepts, everyday applications to the stock market. I'll include a link both to to Nanos and to our own program in the episode bio, so you listeners can check it out. But yeah, Michael Izhaky, Rob Hocking, thank you guys for coming on again. Best of luck. 2022. You guys are going to have some exciting things going on. I can't wait to hear all about it.
Thanks, Patrick. Thanks for having us today. And we're excited about this one and look forward to coming back and talking about the next exciting thing in the future.
Yeah, can't wait. Thanks again, guys, and cheers.